Hi guys, this is SCMPE Jain. Welcome to the channel. Today in this video we'll be covering chapter number 1. All the theory and all the concepts from this chapter will be covered today in this video. Mostly if you are covering the syllabus of this subject, strategic cost management and performance evaluation from unjumbled or from study material or from any other reference material, it is completely fine as long as the theory is as per the study material standards. Today we're going to be using these charts which I have prepared. These are handwritten charts for chapters, and in these charts we cover the theory portion of the chapters so that you get a one shot of all the concepts from this chapter in a single page, in a single chart. Chapter 1 is an introductory chapter. It introduces you to strategic cost management, which is the half of the name of this subject. In this subject, we start with the introduction of cost management. So, cost management, there are two types of cost management. One is traditional, second is strategic. Under the traditional cost management, what we do is we basically allocate the cost, as in we try to calculate the cost, we try to allocate the overheads as per the traditional method, which is mostly by simply dividing the overheads between the products in an equal basis, which is not the approach taken in strategic cost management, where we tend to implement activity based costing and where we try to ascertain how much cost driver has been used for that particular activity, and based on the volume or on the basis of the volume of activity, we decide to allocate the cost under the strategic cost management. So now traditional cost management may not give you correct results as far as the cost structure is concerned. Cost data might not be proper, which can lead to wrong decision making. Also, traditional cost management suffers from a few limitations which have been discussed here. The learning approach or the learning technique could be IFRS. From I, we have ignore. Ignore means that traditional cost management ignores competition. Competition is ignored because there is internal focus when we talk about traditional cost management, because it deals with historical data, it deals with internal assumptions, and then based on that, your internal targets are created. Then you compare your actual results with the targets, and then using standard costing, you try to control them. But in overall, this approach, traditional cost management suffers from this limitation that it ignores competition. What is happening in the market? What are competitors doing? That is completely ignored. Secondly, market growth is not taken into consideration because we are setting targets on the basis of internal assumptions and historical data, which means if we take an example, if let's say the previous year's turnover was let's say 100 crores, and this year we want a 20% increase in our turnover, so our target is now 100 crores plus 20%, right? So 120 crores. So now your turnover target is 120 crores, but the market segment, or if you look at the market, it is booming right now. And because of such exceptional scenarios that might have happened in the market, let's say that in our example, the market growth is happening at 35%. So now your turnover should have happened or should have increased by 35%, right? Because the market is increasing by 35%. But because you have selected a 20% target for your own, even if you are, let's say, performing at 25%, from the market standards, you are not performing as well as you were supposed to. But from the company's targets point of view, you are doing much better than the target, right? So they might reward you even if you have an increase in your turnover of 25% while your target was just 20%. They might reward you. But if you look at the market approach, they shouldn't have been rewarded because they have underperformed than the market, right? So market growth is also ignored under the traditional cost management system. Then customer requirements is not focused upon. Mostly our focus is on cost reduction, and we don't care about the customer requirements much under the TCM or the traditional cost management, which I'll be referring to as TCM from now on. Customer requirement is basically quality, okay, then the type of product, customer responsiveness, all right, innovation, all of those things are not focused upon under the TCM because we're just focused on reducing the cost. Then similarly, market dynamics, must like market growth and competition, market dynamics is and economics is not considered under the traditional or TCM. Okay, so ignores you can learn this way. IFRS, I means ignore, and ignores what? Competition, market growth, customer requirements, market dynamics, and economics. Okay, then comes F. F is focus. As I have already told you that excessive focus is there on cost reduction, and which results in no consideration of other factors. Right. So traditional cost management has a limitation that there is excessive focus on cost reduction, while there is a limited or a very negligible focus on review of work or improvisation of work. Okay, so review and improvisation is lesser, and cost reduction, focus on cost reduction is higher. Then it is a reactive approach. Things happen and then you accordingly react. You cannot basically under TCM, you are not able to predict. You do not even try to forecast what is going to happen or create dynamic targets. But under this TCM approach, you are mostly following the reactive approach, as in once the market changes and then only you decide to change, which might also be delayed because of the approach that is followed under the TCM system. Also, it has a short term outlook, as in decisions are taken from a very short term point of view. From a long term point of view, you would be focused on financial as well as non financial measures. But from a short term outlook, you are mostly and only focused on the financial measures, which happens under the traditional cost management system, because as we've already discussed that there is excessive focus on cost reduction. Therefore, because we are focused on cost reduction, we are only focused on the numbers and the cost numbers, right? So based on that, there is a short term outlook. We try to reduce the cost because there is a focus on cost reduction, and ultimately it leads to a different scenario in the long term. Okay, so for short term, for S, you have short term outlook, which is another limitation of TCM. Let's move to SCM, how it became hero and made TCM a zero. Okay, so SCM or strategic cost management, there are benefits and necessity of this method. So the entire concept of strategic cost management tells you that what you need to do as a company is that you need to be at the top, right? A company would want that not just it is earning decent profits for its shareholders, uh, also it wants to be at the top of the industry, right? It wants to be the number one company as far as the customers are concerned in the industry. The company would want that the customers prefer this company over any other competitors, right? So that is the improvement of strategic position. All right, if you want to be at the top, that is improvement in strategic position. From wherever you are, you have to understand what kind of value are you creating right now, okay, and how is it different from your rivals. So based on that, you need to improve, and accordingly you need to reach the top of the ladder. So benefit of strategic cost management is that it will help you to improve the strategic position. It will help you to be at the top. Okay, then also, as I've already mentioned before while discussing TCM, that strategic cost management uses activity based costing as a technique or a method to allocate the cost, through which you get better cost understanding because there's a structured cost information, also much detailed, right? So you can use this cost information, analyze it, and use it for better decision making. Okay, so SCM helps you to use cost information for decision making. Now SCM will also help you achieve sustainable competitive advantage. Now what is this term? This term is very important from chapter 1 per se. Okay, so from in fact not just chapter 1 but overall in general for this entire subject, this sustainable competitive advantage term has a very big importance. Sustainable competitive advantage basically means that you are either differentiating your company on the basis of differentiation, okay, or you are using cost leadership as a measure to differentiate your company. Okay, so basically you have to stand apart from your competitors. Either you are using differentiation advantage or you are using cost leadership. There are only two ways in which you can achieve sustainable competitive advantage. Of course, there is another focus strategy which helps you decide which of the two, as in which of the two being differentiation and cost leadership. So which among these two are you going to select for your competitive advantage? Okay, so you have to achieve this competitive advantage. Now what does the word sustainable do here? So sustainable tells you that basically competitive advantage is not to be achieved just once. You have to achieve it over a long term, and that is what sustainable means, right? And of course, because we need to achieve sustainable results, there has to be a continuous improvement, which is also a benefit of strategic cost management. Now, strategic cost management has certain components which are very important. There are three components. One is strategic positioning analysis, in which we analyze the strategic position of the company. Now, the strategic position can be analyzed on the basis that what kind of value is the company creating, how is that company creating the value, okay, and how is it different from the rivals. These are the 3 points to keep in mind while analyzing the strategic position. What kind of value, how are you creating this value, and how is it different from the rivals, okay. Now, there are factors which affect the strategic position. One is external environment. Of course, there are factors in the external environment, the market, which affect the strategic position. Something happens in the market when you're not able to react to it. Customer preference changes, which is again external market, and you're not able to cater to them on an immediate basis. Then, of course, it is going to affect your strategic position. Maybe in a short term, and then you adapt to it, and then in the long term, it is not much affected. But these are the factors which affect the strategic position. There is external environment, of course, there is internal environment, your productivity, your delivery timing, okay, your yield, everything comes into picture. And then the last one is value, culture, and system. Okay, what kind of value do you have under your organization, in your organization? Let's say, so for understanding this point, I use this example always, and I really like this example. That imagine if there are two vendors, okay, and both of them are equally good, both of them are providing the same things, both of them provide at the same rate as well, okay, so everything is same, but you have to decide one among the two, of course. So which one are you going to select? Now that depends on what vendor do you think has more value, better culture, okay, or better system. So that is what ultimately affects the strategic position as well. All right. So this is more like a non-financial kind of thing. Of course, these three are all non-financial kind of thing, but this is more like, you can say, related with ethics, okay, or the culture of the organization, how it deals with things, how it operates in the industry. Everything considers everything is considered under this point. Okay, next component in your strategic cost management is cost driver analysis. Okay, you might have heard me speaking cost driver when we were discussing activity based costing a few minutes ago, right? So what is cost driver analysis? Cost driver analysis basically that you are trying to understand the cost of the organization, and what is the driving force for this cost, or what leads to the incurring of this cost. Okay, so whatever cost you are incurring, what is the reason behind that, what is the driver behind that? So you try to analyze these drivers. Okay, now there are two types, two categories of drivers. One is structural cost drivers, second is executional cost drivers. Structural is related to the organization structure, executional is related to the operations of the organization. So certain things to be considered under structural cost drivers would be the scale of operations or the scope of operations. Okay, how big is the organization structure? How big is the scale of operations that you work under? And then there is learning curve, which affects your cost of course. And there is executional cost drivers, which relate with the operations of the organization, and therefore are much related with the plant layout. The efficiency depends on the plant layout and the participation and competency of workforce and management. Okay, the third uh, component, which is very important from the entire subject point of view, is value chain analysis. Value chain analysis tells you that there is a value chain which you need to analyze. Now, what is a value chain? Value chain is basically all the activities through which an input passes for the conversion of it into output. Okay, so basically, input is passing through certain activities. These activities are all integrated, and then ultimately the input is converted into output. So at each of these activities, there is a certain value that is added to these inputs. That is value chain. That is why the hence the term value chain. Okay, now, to analyze this entire chain is value chain analysis. Under this analysis, you try to identify all the activities. You try to check out which of these activities is actually creating value, which of these activities are actually adding value. And there are certain activities which might not be adding value. Now, those activities which do not add value have to be eliminated in such a manner that ultimately your product or your process is not hampered and not affected. And then all the value adding activities have to be arranged sequentially or in a manner that results into efficiency. Okay. Now, value chain analysis tells you that there are two categories of activities. One is primary activity, second is secondary or support activities. Primary activities are directly related with the conversion of input to output. Secondary activities are those activities which actually support the primary activities. Okay, so there are five primary activities. The first one is inbound logistics. The materials come in, are stored. Okay. Second is operations. Operations is conversion of input to output plus inspection. Okay. Third is outbound logistics. Outbound logistics is storage of finished goods and delivery to the customer or consumer. Fourth is marketing and sales. Just by producing the finished goods, you cannot sell the product, right? You have to market the product. So selection of distribution channels, advertisement, everything would go into marketing and sales. And last is services. Services you need to provide along with the sales also, like installation, or after the sales also, like return management, claim handling, complaints handling, complaint management, everything would go under the services part. So these are the five primary activities. Then comes four secondary activities. Now, what are these secondary activities? Starts with procurement. Okay, you have to first procure the raw material or the inputs for inbound logistics, and then the operations happen. So the first step is procuring, and that is a secondary or support activity. Second is, or you can say, firm infrastructure. Firm infrastructure is not just the physical infrastructure, okay, but also departments like finance, okay, and planning, management, okay, accounting, all of these, or yeah, all of these would be, or legal, all of these would come under your firm infrastructure. These provide support for the operations to happen. Then comes your human resource management. Human resource is a very critical uh, part or very important factor for any organization, because we create strategies, right? And they actually operate, they actually turn the strategies into real. Okay, so human resource is very important, and management of it becomes of utmost importance to any organization. So human resource management would be dealing with recruitment of people, okay, managing people, or providing training to them, rewarding them, recognizing them. Okay, all of these would be human resource management. And the last one is technological development. Of course, technology has to be a key role player in any organization, because technology keeps changing, and using technology you can do a lot of things which you might not even have thought about. Okay, it may make your process very simple or easy. It may reduce your cost. It may provide you with a differentiation advantage. So technological development is another support activity. Okay, but just like value chain analysis, so value chain analysis is mostly used or majorly used for companies which are into manufacturing. Now, for service sector entities, there is another model just like value chain analysis called value shop model. Okay. Now, this value shop model shares the secondary activities, as in it has the same secondary activities or supporting activities, but there are different set of primary activities. There are five primary activities. One is problem finding and acquisition. You have to find a problem that you want to solve, and you actually decide among the different set of problems that exist. You select one problem that you want to solve. So that is problem finding and acquisition. Next comes solving a problem. Okay, so the problem that you have selected needs a solution now, so you decide on the various solutions that you can create for this problem. Okay, then choice. Among the possible solutions that you have developed, now you select the best solution alternative that there is for execution. Then comes the execution, which means actual happening of the solution that you have selected now. And ultimately, controlling is monitoring of the operation. Whatever you're doing has to be monitored, if you are doing it correctly or not, if the results are correct or not. All right. Value shop model does not deal with input to output conversion, it deals with solving of problems. Now, a strategic framework is required for value chain analysis. So there are three topics under this heading. First is industry structure analysis, okay, which is also known as Porter's five forces model. To learn this, you could use TBTBR, which I use. First is threat of new entrants. Okay, so basically here we deal with what kind of barriers could there be for the new entrants, barriers to entry. All right, if these things are there, then there is a barrier to entry, and new entrant cannot pose a big threat to your organization if you are already there. Okay, so first thing is capital. If capital requirement is huge, then new organizations or many new organizations cannot come under this industry. Therefore, it can create a very big barrier for the entry of any new entrant in the industry. Second is technological. Okay, if a lot of technology is required under this industry, which would result into a lot of investment being required. So ultimately, it is just like capital point. Okay, if technological advancement is required under this industry, then it will create a barrier to entry. Third is government regulations. If the sector is regulated and government has a lot of, let's say, regulations imposed, regulatory bodies are there which impose certain regulations, then ultimately it will create a barrier to new entry. And then limited raw material or labor. Okay, if the material or the labor required for this work is limited, okay, in the industry, then of course it will create a barrier to new entrants. Okay, next is bargaining power of buyers. Bargaining power of buyers would be high if the number of buyers are less, okay, or if a buyer is purchasing in volume, okay, volume discounts. Then if the buyer is a big company, it can exercise power. And then of course, if the switching cost from one supplier to another supplier is low, then you can easily switch between the suppliers, right? In that case, again, bargaining power of buyers would be low. Sorry, high. Third is substitute, threat of substitute products. So if there are multiple substitutes available, threat is going to be high. Also, if there is competitive pricing, the threat is going to be high. Okay. Then bargaining power of suppliers. If there are number of suppliers, if the number of suppliers are less, then the bargaining power of supplier is going to be high. Okay. If there is no alternate supplier, though no alternate supply of this product, then again suppliers bargaining power will be high. If the switching cost from one supplier to another is high, then the buyer would not be easily able to switch between the suppliers. In that case, again, the supplier's bargaining power will be high. And if the buyer is a small buyer, then the supplier will uh, bargain well. Okay, so power will be imposed there. And the last one is the rivalry among existing firms. If the firms are of equal size, there is going to be more competition between them. Okay, if there is extra capacity in the industry, the firms are going to compete for this extra capacity, for the share in this extra capacity. Okay, if the differentiation of product is very difficult between the existing firms, then again rivalry is going to be high. Okay, and if the exit barriers is high, you cannot, once you enter into this industry, the firm cannot exit. So then it has no option but to snatch the share of market, right? So again the rivalry will be high. Then comes your core competency analysis. Core competency is basically a unique skill or a technology that you have, which can help you differentiate yourself from the rest of the competitors. Okay, so how to assess if you have this unique skill or tech or a core competency or not? So you need to check if your end product benefit is high. If the product benefit that you can give to the consumer is unmatched by the competitors, then you have a core competency. If the access to the markets is high for you, if you have a wide variety of access to markets, okay, then again you have a core competency. If your product cannot be copied, cannot be imitated, and it's very difficult to imitate your product, then again you have a core competency. Okay, now to use core competency to achieve competitive advantage, how, what can you do? First, you need to identify if you have a core competency. Okay, identify or validate if you have one, then leverage or use from the existing ones to the new one. Okay, the core competency that you have in the existing process or product, use it for the new process or product. Okay, so leverage it or use it. Third is reconfigure the entire value chain of the new one or the existing one, and then create a new value chain, uh, if you have to, for the new process or product. Okay, this is application to gain competitive advantage. We have already discussed what is competitive advantage. Let's look at it again in a very quick manner. Competitive advantage can generate it from two ways. First is differentiation advantage, second is cost leadership. Differentiation is basically differentiating yourself on the basis of features, and cost leadership is differentiating yourself on the basis of cost, as in the price. Okay, so under cost leadership, it would be very simple that you want to reduce the cost so that you can sell at lower price than the competitors, or you are selling at the same price as the competitors but with higher value. Okay, higher value as in providing more value to the customers using your product. Okay, better quality product at the same price than the competitors. Okay, that would be cost leadership. And differentiation advantage would be that the customers have to perceive that your product or service is superior than the competitors. It does not matter if it is actually superior than the competitors, but what matters is that the customers feel or think that it is superior. Even if it is not, it doesn't matter. Customers have to perceive that it is superior. Okay. Now, how superior can be perceived? Okay, there are three things which can help you in this perception. First is either you have superior quality. Okay. Second is either you have superior innovation, or there is a superior customer responsiveness. What is customer responsiveness? Responding to customer requirements in a very quick manner. Okay. Now, you can also assess competitive advantage using value chain analysis. How to assess competitive advantage? We are trying to assess competitive advantage using value chain analysis. All right. So, how to do that? So, there is one way called internal cost analysis in which you try to analyze the cost of your organization of this particular process or product or service. Okay, so first of all, you identify all the activities that are involved under this process or product. Okay, then you use activity based costing to allocate the cost to the respective activities. Okay, and third is you find the opportunity to reduce the cost if there is any. Then there is internal differentiation analysis. Just like internal cost analysis, you can again use these activities, analyze these activities to identify if there is a differentiation advantage that you can use from these particular activities. So you will identify if all the activities, which activities are there for this product or process. Okay, assess if there is any activity which is unique. Okay, any activity that can provide a differentiation factor to your organization, and you will select among those. If there is anything that you can do under these activities that can help you differentiate. Third is vertical linkage analysis, which tells you that not just internal focus but externally also you can assess competitive advantage. Like from supplier to customer, there is a linkage. Okay, supply can provide you certain things which can prove to be a competitive advantage for you. Let's say information. Okay, based on this information that supplier can provide, possibly, probably, uh, you could try to reduce the cost. Okay, use certain material which can improve your quality and as well as reduce the cost. Again, this leads to a competitive advantage, right? So supplier can help you, customer can help you with the information. All right, so that is vertical linkage analysis. And the last topic under this chapter is segmentation analysis. Segmentation analysis is basically that you identify multiple segments under the industry. By this what I mean is that if there is an industry, let's say, let's take an example of fashion industry. Okay, clothing industry. So under this there will be certain segments: women's clothing, okay, men's clothing, kids wear. Then under men's there would be formals, there would be casuals, there would be ethnic. Similarly under women's there would be formals, there would be casuals, there would be ethnic, or there could be more. Under kids there could be multiple. So that way there are segmentation, right? There are multiple segments. So first of all you need to identify all the segments that there are. Construct a matrix. What all segments can you go into? Which segment are you currently working under? Okay, which segment can you go into? And if you can, then what benefits that you can use from the existing segment that you are working in. Okay, then you need to analyze the critical success factor for that segment that you want to move into. Okay, if you are so segmentation analysis will help you decide if you want to move into multiple segments, what segments to move into. Okay, if you want to quit a particular segment, should you or should you not? Okay, if you want to move into multiple segments, then how can you do that? So segmentation analysis will help you with that. So you need to analyze critical success factors of that particular segment. If you want to move into another segment or multiple segments, then all of these segments, identify what factor is critical for your success under that segment. Okay, what do you need to achieve to be successful at that segment? Would you be using cost leadership under that? Would you be using differentiation advantage under that? You have to select on that, and segmentation analysis will help you do that. Ultimately, you need to identify if you want to go for a broad segment or a narrow segment. Decide among those. So broad segment would be that, let's say, menswear. Narrow segment would be ethnic clothing for menswear. Okay, so broad versus narrow is that, and this brings us to the end of the chapter. Before we end this video, I would like to quickly tell you that for the limitations, there is a case under in case study digest. Also, there in scope view if you have scope view already. Scope view, by the way, is our case study book which has 101 cases. So not just ICI, but also we've added a few extra for ensuring that you have a good enough practice of the cases. So this is in case study digest, which you should do for limitations of TCM. Then there is another case for, there are certain cases for value chain analysis in your module 3 that you must do. Value shop model has another case in module 3. It might be removed now because institute has removed it. I think you should still do it. Okay, so you should do this from module 3 from the older one, or if not, then it is of course there in the scope view charts. uh, Again, industry structure analysis has a few cases in the module 3 as well as case study digest. One of the cases in case study digest called Safe and Visory Advisory Limited is a case on insurance company and use of this Porter's five forces model on the insurance company, which I think is a very good case and that you should do. Yeah, that would be it for this. And for competitive advantage, also there are certain cases in there is one case I think in module 3 now, and of course it is there in the scope view book. So that case also, it is called BA Airlines, that also you should do for the competitive advantage. Okay, so this brings us to the end of this video. Thank you so much for watching this. If you are new to the channel, hit the like button, hit the subscribe button to the channel, and also hit the notification bell icon for the latest notifications, and so that you can be updated with the latest videos that I bring for the subject strategic cost management and performance evaluation. I hope you like it and I hope you benefit from it. Thank you so much for watching again. For more such videos, click on any of the videos that you like. All the best, take care, and I'll see you next time.